The economic survey is here. Finance Minister Nirmala Sitharaman tabled it in the Parliament today. This is a very important document if you want to understand the why of the budget. So what does it actually say? Well, overall, despite global trade rules breaking down, capital becoming cautious, and geopolitics shaping economics, India's economy is performing better than it has in decades. But how strong is India really? What does it mean for you? And what pressure does the economic survey put on the union budget? Let's start with the state of the economy. Now, the survey says India's growth momentum is intact. It is expected to grow over 7% in real terms. The survey has revised India's potential growth rate upward to 7% from 6.5% last year, and this is attributed to strong public capex, improving logistic efficiency, and rising private sector balance sheet strength. Now coming to one of the strongest positives in the survey. Headline inflation still shows food price volatility, but core inflation remains subdued. Now core inflation excludes food, fuel, gold and silver. What it indicates is strong supply side capacity and better logistics. On fiscal strength, India's FY25 fiscal deficit stood at 4.8% of the GDP. Budgeted target was 4.9% and FY26 target is 4.4%. India has also got credit rating upgrades from Morningstar, S&P and RNI. But on state level, there are fiscal risks. Survey points rising revenue deficits in several states, growth of unconditional cash transfers and capital expenditure getting crowded out. India's 10-year bond yield is at 6.7%. So the survey bluntly says state fiscal behavior is raising India's cost of borrowing. On rupee, well, despite strong growth, low inflation, healthy banks, robust forex reserves, rupee underperformed last year. Why? Because India runs a trade deficit in goods and depends on foreign capital inflows. It also has a services surplus and remittances, but that is not enough. The survey says countries that run persistent current account deficits must pay a risk premium. Current account deficit means that a country is spending more on imports and earning less from exports, which is basically a country spending more foreign currency than it earns. The survey gives clear export numbers too. Since 2020, total exports rose 9.4% CAGR, merchandise exports at 6.4% CAGR, and services did the heavy lifting. But the survey warns that services exports do not force institutional upgrades. They do not build logistics, factories or mass employment. Manufacturing exports do. So that is why currency strength globally is linked to manufacturing excellence. India has also signed major FTAs with various countries, one of them being the India-EU agreement concluded recently, which expands access for labor-intensive manufacturing. But the survey stresses that FTAs work only if India can produce competitively. So the survey has criticized high upstream protection, inverted duty structures, costly inputs like power and logistics. It argues that protecting upstream sectors raises costs for exporters and acts as a tax on MSMEs and downstream manufacturers. So the survey recommends lowering cost of capital, improving scale and efficiency, and competing globally. On jobs, the survey says employment growth must come from manufacturing and services. Skills must align with industry needs, and education skills industry link is weak in India. It also warns social trends like rising obesity, non-communicable diseases and digital addiction. It calls for greater private sector responsibility, citizen participation in preventive health, long-term skilling over short-term relief. There is a detailed analysis on AI in this survey too. It says AI can accelerate growth and productivity, but unmanaged AI can worsen inequality, disrupt jobs and create financial risks. India must use AI to augment human capital backed by strong skilling and smart regulation. So in summary for you, the positives from the survey are growth stability, lower inflation risk, stronger banks, better infrastructure, more long-term job potential, and the risks are high borrowing costs, slower job creation if manufacturing stalls, fiscal populism, crowding out development, and currency volatility during global shocks. So based on the survey, what the budget is expected to focus on: 1. Fiscal discipline. 2. Capex over cash transfers. 3. Manufacturing competitiveness and MSME credit. 4. Jobs and skills aligned with industry. 5th, energy security without cost shocks. And 6th, export-led resilience, not protectionism. So the economic survey leaves us with a stark choice: short-term comfort or long-term strength. In this volatile world, India must grow fast, build buffers, strengthen institutions, and stay competitive globally. So India must run a marathon as if it were a sprint. But are we ready? The budget will tell us. So stay tuned to ET Now for more views and views, and on February 1 we bring you the most extensive coverage on budget 2026. So don't forget to watch ET Now on February 1st.
If you like this video, then like, share and subscribe to ET Now.